This is Alan Bush with ADMIS. In the stock index futures, we are seeing prices just a little bit lower this morning. We did have a business confidence index coming in a bit on the weak side, so that's putting a little pressure on futures early. Also, in light of the recent non-farm payroll report that did come in better than expected, some analysts now are predicting that the Fed will taper their quantitative easing program at the December meeting. However, the majority view still thinks that we will see a tapering at the March 2014 meeting. My own analysis suggests that the Fed will taper later than that, especially if the Fed does not perceive an imminent inflation threat. It is more likely that they will taper later rather than sooner. So a later tapering is bullish for stock index futures, and I think today that even though we are a little bit lower, that we will see a recovery in prices. Over in the foreign currencies, seeing the euro currency higher now for a second day. A lot of this seems to be short covering after those very hard declines that we saw late last week. This after last Thursday, the European Central Bank, in a surprise move, lowered interest rates to a new record low of 25 basis points. So there may be some follow-through short covering in the euro currency. Also, we are seeing some pressure in the British pound. This after UK inflation numbers on an annualized basis coming in much weaker than expected. Of course, this is bearish from an interest rate differential point of view. And the pound lower, even though we did have some better than expected UK housing numbers. The Australian dollar under some pressure. We did have a business confidence index number coming in on the weak side, so that putting pressure on the Aussie dollar. Credit markets seeing treasuries just a little bit lower. However, we are thinking that if we are right, that the quantitative easing program from the Fed will be extended. That bullish influence will gradually support the credit markets, bringing it back from the lows that we saw over the last several days that were due to the very bearish non-farm payrolls report. Also, we are coming up against a new series of Washington-imposed financial deadlines starting in mid-December. So there could be a flight to quality bid coming back into the treasuries. So look for a gradual recovery in treasuries over the next month or so, and still thinking that QE will be the dominant influence to support the credit futures market. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.